Thank you, Bill. Thanks, Vanessa.
You're welcome.
Good morning, everybody. Welcome. We will call to order the quarterly regular meeting of the Lawrence County Retirement Board. Today is Tuesday, November 12 of 2024. A couple housekeeping items. We'll note that this meeting is being live streamed. It's also being recorded. Ask that if you have a cell phone of any type, if you'd please put it on vibrate or silent. We appreciate you doing that. We always start our meeting with the Pledge of Allegiance, and then if you'd remain standing for a moment of silence, Mr. Prestipine, could you lead us in the pledge?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Please remain standing. We'll have a moment of silence. Thank you. Could we please have a roll call? Brian.
Controller Prestipine,
Here.
Treasurer Rapone,
Present.
Commissioner Sanada,
Here.
Commissioner Kennedy,
Here.
Commissioner Vogler.
Here. All 5 members of the retirement board are present and accounted for. We've noted in the past that the laws of the Commonwealth stipulate that counties, particularly counties of our size, fifth-class counties, that the retirement board be comprised of the 3 county commissioners, the county controller, and the county treasurer. We have oversight of the county's retirement fund. We always have time for public comment. I'll note right now we don't have members of the public in the room, but if anyone should show up, we welcome their comments. We'll before we adjourn, we'll reopen for public comment. We ask that the comments be related to retirement board matters and that anybody making comment try to limit their time to about 5 minutes or so. In our packet, we have the minutes of our last meeting. Forgive me, before we turn to those minutes, I want to note for the record that on October 22nd, which was a Tuesday, the Salary Board held an executive session to discuss a personnel matters. So make note of that fact. And, well, do we have minutes?
Oh. Sorry.
We don't have minutes in our packet. Are
That's
they
my
not
fault.
available?
They are there upstairs.
Well, we can do one of 2 things, gentlemen. We can wait for Ryan to go up and get them, or we can forego minutes until the next meeting, whatever your preference is.
Can we skip it and come back to
We could do that. Let's do that.
it?
Okay.
I'll run up to go get them.
Thank you.
My apologies.
That's quite all right. Thank you. So while Ryan is going up to get us copies of the minutes, before I turn it over to Sarah from Marquette to give us our investment consultant report, I should, though, see if my colleagues have any opening statements or concerns, and I'll start with Mr. Kennedy.
Nothing.
Thank you. Mr. Prestipine?
No.
Mr. Rapone? Mr. Sanada? No. Okay, thank you all, gentlemen. So that takes us to item 4. Sarah Wilson is with us to give us her update. And it's always a pleasure to have you, Sarah. Now you brought along your document, so I'll turn it over to you.
All right, well, good morning. We're first going to do the quarterly report, and then we'll do the PA database report that we know we do every year for you. So if we turn to Exhibit 2, page 10, we'll talk a little bit about the economy. And I always find it very interesting that I always say, by the time this is printed, it's completely changed. Actually, it hasn't as much, and we'll talk a little bit about the Fed. I think we were right on where they were going. But we look at U.S. real GDP growth, and we look at what happened quarterly, year over year, and we see real GDP increasing at an annual rate of 2.8%, acceleration of consumer spending along with sizable contributions from federal government spending. So that's kind of really upholding it. I do think that when we look at U.S. Payroll growth, we know that the largest payroll, and you can see at the bottom of that, is construction, utilities, education, and health. So that's really what's driving the U.S. payroll growth. We know that Employers added 254,000 jobs in September, but interestingly enough, farm payroll in October only did 12,000. So we're gonna probably see a little bit of shift on that. And then we talk about what's happening with consumer delinquency, is at the highest level since 2020, but the aggregate household balance sheets remain robust despite higher rates. So probably what's happening is consumers just credit card along and they still have their 401ks. We've seen huge growth in that. So with the market there. We know what we see is the labor market versus inflation. And we know that actually that's really starting to tighten. We have seen that for the jobs, the people seeking jobs, is approximately equal to the open positions. So what has happened there that we have seen is, remember 2020, we always go back to 2020, nobody could get workers to come back to work. So in the course of those 4 years, some companies, did cuts, some companies didn't fill those positions again. So it kind of shrunk a little bit just from that. What happened, we know with the election, whether, whatever side you were on, we know that the election, the way it went in there, they're hoping that the economy will grow a little bit more. You can see what happened with the stock market last week, and they look at what's going to happen if they really do the tariffs. That may have an effect on employment there. We look at what's happened in short-term rates, and I think what we have seen, remember, we saw these interest rates on the bottom of page 11. We saw the hike, then we saw the drop. We know that the Fed came out and cut rates by 25 basis points this month, and we know the range is now 4.5 to 4.7. Which is keeping U.S. expansion on solid footing. Powell cannot get fired. We know there was that in the press a little bit. He said he would not resign. Inflation slightly above the goal of 2.1. And the labor market's cooling. The market has priced in 75% chance cut in December, but next year the market thought there would be more cuts. And really what has come out, even today that's come out, is that we're not going to see as many cuts next year. So that really cheap level of interest rates at 3%, when it went all the way down, and we saw that, we're not going to see that for a while. And that's going to be tough on the consumer. We've seen how higher interest rates have really affected emerging markets and small and mid-cap companies, because that's more expensive. They usually borrow to grow the company. So we're going to look at that and see where they are. We believe that going forward, we may have another 1% cut next year, but it's going to be done in quarters, and they're going to wait to see what happens with the market. We turn the page and we look at page 12, and we look at what's happened with the PMI of the Eurozone. Has been below 50, the level which marks expansion from contraction for 27 consecutive months, the longest streak since it began in 1997. So we have seen growth slowing in the Eurozone, but the European Central Bank began cutting interest rates in June, and that's actually higher rate sensitivity of the region due to consumer exposure to floating rate mortgages. The consumer in Europe has floating rate mortgages because property is so expensive there that it's really hard to go out and buy. Like the tiny little homes are so expensive. So they do a lot more floating rates. So when the rates are higher, the consumers really have struggling when they go down, obviously, but when they're rolling, we can see that doing. We also know there's been economic stagnant for China. And we look at the China economic stimulus and look at that down below. We look at the 2015 market crash and look at the percent of GDP. We look at the monetary easing and the fiscal measures. We go all the way to COVID and we look at that. And then we go over to 2024 estimates and we look at the percentage of GDP. So what we're saying is the slew of stimulus has started to become a little bit more effective there in the economy. Chinese economy. And we know that they struggled from rebounding from COVID, and they also, the consumers actually sitting on a lot of cash. So we look at page 13, we talk about the asset class. So we look at US equities for the quarter did 6.2%, but for the trailing 12 months, 35.2%. Non-US equities, 7.3. And I really like this graph because usually this graph every quarter's got something in the negative. And we don't have anything in the negative here. We talk about what's happened. We know that the US improving fundamental backdrop for small equities, increasing easing pressure from interest rates. So we're going to see some acceleration in sales growth, including fiscal spending. And we look at non-US rate cuts in Europe have been a tailwind for non-US developed equities. So we've seen a little bit of improvement in capital allocation by management teams, investing in Japanese companies, and we've seen that has really boomed. We look at where high yield bonds are at 5.3%, and we look at global commodities, have struggled a little bit, but we know that that's been the decline in oil prices there. And we look at US REITs, real estate, US REITs were up the trailing 12 months, 34.8%. And that always happens when you see lower rates. We look at page 14 and we look at the sector returns. And, yet again, what we have driving are these mega caps. Even though they haven't been driving it as much, they're still driving a huge portion of this market. And we look at what's happening. Energy was down, but we look at consumer discretionary up 8.2. We look at information technology only up 1.8, but trailing 12 months 50.18. So some of those companies, Apple in the second quarter was in negative. Google's now negative for the quarterly return. So when we look at some of those companies, it's starting to get back in line there. And it's been wonderful to have this huge market, especially, you can see a lot of growth within the pension fund, but it's not good that there's certain stocks driving it. You kind of want more of a broad market doing that. We look, value actually outperformed this quarter, year to date. It did not, growth underperformed, but year to date, it outperformed. And we look at growth versus value. When there's a very volatile market, and this was an extremely volatile quarter, even though we saw very record highs. Yesterday, we hit another record high that was about 44,000, and we just see it just go. A lot of times, there's a lot of volatility with that, so that value kind of take will help you in that market volatility. We look at quarterly returns in the presidential election year. This is kind of like thrown out the window after last week, but we have to look at what it does historically and the average, because this is where, companies look at where the market is, economists look, and that's what explains what happened in the third quarter. Remember, we're not looking ahead, we're looking at explain performance there. So one day to election, we look at returns. The mean since 1984, we look at that, the cumulative return is about 0.35. Since 1984, the day after the election is about 2.3, and the fourth quarter is about 2.47. It'll be interesting to see where that is at the end of this quarter. We know October was a down month for equities, and it was, down month. You were off a little bit, but like $500,000. So, less than a percentage point. But we know this quarter has gone up, and then we'll usually see the markets kind of flat for the rest of the quarter. There. We see where presidential cycle returns, and we look at the probability of a positive, and we might as well look at year 4 at the bottom. We see that, you can see that the average return 7.5, the median returns 10.7, and there's 75% probability of hitting that return. So fourth quarter, we're always hoping to finish off. Yeah. Are there any questions on the market? All right, let's talk about how you did. This is, so we look on page 22. You had a return of 5.6. You outperformed the benchmark of 5.5, and that is net of our fee and all the manager fees, any fees that come out of here. So with a net investment gain of 5.6 million. For year-to-date, you were 12.6 versus a relative benchmark of 12.5 and had a net investment gain of $12 million. So it's been so far a really nice year. Since inception, you've annualized 7.9% and had a net investment gain of $66 million. Positive attribution for the quarter was active manager Eaton Vance, the value tilt, defensive equity, and your fixed income manager. Remember, we switched them out. We put CS McKee in there, and they've been they're an active manager, and that has helped for performance. Negative attribution. We'll talk a little bit about one of the managers, non-US equity composite, and that's always kind of struggled. You have to have exposure to it, but we take a very value approach to that, very defensive approach. So when the market's going up and up, our managers are usually kind of below a little bit, but when the market goes down, they usually outperform the negative there. And then low investment management fees of 29 basis points. We added fixed income manager Barry 4 Plus, and we'll review the 2024 database report. Are there any questions? And the only thing to point out on page 23, and this is where going into real estate, going into defensive equity, going into infrastructure, go look at your 3-year. Your 3-year included 2022, which is double digits down, negative. You annualized 5.9 versus 5.5 and still had a net investment gain of 17 million. I think that's really to point that out, that's really where you start seeing all of that asset allocation that you did really helped you out there. So kudos to you for making those changes there. Any questions so far? All right, let's turn to page 32. We'll just look quickly at your performance. I want to talk a little bit about some of your managers there. Under your total US equity composite, as I said, Eaton Vance on page 32, halfway down, is your SMID, small and mid cap, which always do well when you see rates coming down, and they have outperformed year to date 17.2 versus 11.3. And as we always say, that, you know, having a large cap value or growth manager in there, it's very hard to find a manager that will outperform the S&P 500 that's worth paying the management fee. So we always put that into an index, and then we look at where you are. The active is your Eaton Vance. So we like small and mid cap to be your active manager there. When we look at global equity composite, I know Dodge and Cox has just trailed a little bit. They are going to be your volatile, and you can see them for 3 years. They have annualized 9.9 versus 8.5. They're fine. It's just some stock selection. And remember, we also still have to go back to those mega caps, which are driving these benchmarks. So you don't want your manager just holding 7 stocks. So they're going to have a hard time outperforming sometimes the benchmark. And then we look at Artisan, actually has come back a little bit, 4.3 versus 4.1. I know we look at some of their performances a little bit tough. Remember last year, though, they were the #1 performing in their space, manager in their space. They just had a really bad, tough year versus the benchmark. MFS Low Volatility has done very well in the trailing 12 months. They've done 28% versus 22.9. And then we look at your non-US equities. Harding and Loevner actually went to the research team on Harding and Loevner because we've not been very impressed with the returns there. And you can see since we've put them in, they have struggled for the last 2 years. And their net performance was relatively in line with the benchmark during the quarter, but still trailing the benchmark on all time periods. And what we looked and dove into has been driven by stock selection, and they have had a little bit of selection in healthcare weighted on performance, as did the underweight in real estate. So that's attractive from there. We talked to both head portfolio managers. We're still very comfortable with them. We do believe it was stock selection there, but when we did look at them, it's still one of our top picks, this strategy. We like this strategy, but we're probably going to start looking for another manager that may fit into that space. You know, you can't you know, when we looked at Harding and Loebner for the last trailing 12 months, we really, really liked them. Remember, it all fits into space. It's all a puzzle that makes it work. But we are on it, just, you know, so you know, the research analysts on it, I'm on it, the OCIO team's on it, so we're just looking at that. Because normally when you see that much of a difference in performance, kind of puts a red flag up. We're not red flag yet. There, and we also have the ability to pull them every week. We can just go pull them out of the portfolio. So I just want to let you know that. When you turn the page, you look at your real estate composite. Negative territory, but you know, remember 2 years ago, they were outperforming, and that's actually, we're gonna start seeing real estate kind of get back on track. And it's also a very nice thing to have in your portfolio because it does give you income. Remember, you are making pension payments. Look at infrastructure. For the trailing 1 year, they've done 8.1 versus 5.5. So they have really outperformed, and that's nice, 5%. We know they also are a hedge against inflation, and I think you'll start, infrastructure is never going to go away. So we like this as a dividend paying component of the portfolio. And then you can see we put in Baird Core Plus Fund. We'll start talking about performance there next quarter. And then we CSWIC did 5.3 versus 5.2, and year-to-date 4.9 versus 4.4. In the trailing 1 year, they did 12.5 versus 11.6. So they were, you know, it's nice to have an active manager there, and that's done very well for you. Any questions? You guys have had a long day of these. All right, let's go to the PA database report real quick, and then if you have questions at the end, we can go back and address those. So this is something we do.
This is the second document you've
Second
given us.
document,
Okay,
yes.
thank you.
And just turn to page 4 and 5. This is something we do for every county that wants to purchase. Did you get one?
There's two the same, I have two the same. All for the day.
Okay, no, this is the one you'll.
Yes, did you get a key?
That's right.
This one,
Yeah,
yes.
sorry about that.
I'll do, thank you, I'll give this to Deb. Great, thank you, Rich. You're up to speed now? Okay.
So what we did is, just so you know, we only had 82% participation rate this year, which is kind of lower than normal. It might be because there's a lot of newly elected officials, and you know, it's the first time doing it. So we looked at that. 51% participated out of the 62 eligible PA counties. And just so you know, this is gross of fees when we look at the comparison, and also because it's apples to apples, we take the counties, when we compare the median average, are the ones who've been doing this the whole time. There. You go to page 5, and you can see there you are county class. You can see the county classes. The most county classes are actually county 6. County class year 5, under 5 counties. And then we're going to talk a little bit, page 7. And you've done a great job because you actually make your ADC. In 2008, the average county ADC for 19 counties was 1.9 million. Following 2008, it was actually 4.1 million. And then we look in 2024, the average ADC of the 19 consistently reporting counties rose thanks to part and poor returns of 2022. Remember, when they do the actuarial report, this is 2023, looking at 2020, you know, rose up to there. So when they snapshot that, everybody had to put more money in last year. And then we look at your actual rate of return, and this is what you've done a wonderful job about. Look at your 6.75, which is really nice to see. You know, we still have counties at 7, over 10 counties at 7.5%. Not that they're all hard lines. There, but the average is now 7.14, which is in line of last year's average of 7.15. And then I want to turn to page 13. We're just going to look a little bit at the returns there, and look at your 5-year return. You're at right there. The median was 8.7. but I think this is really where you've done a lot of work here, and we've been here, is you were in the top tier of counties for that 10-year return, which is great. When we turn the page, we look at 2023 returns, you can see that, you're a little bit below, but remember, we always talk about that. You actually, I think you did close to 14.5%, 15% for there. That's fine. You were right where everybody was on there. And those higher returns are usually from very aggressive counties in their performance that are and larger counties that can be much more diversified with private equity, private credit there. So really, you're right there on the medium. And you look at 2021 returns, 2022 returns there, which is very nice. You can see that you weren't down as much as a lot of the other counties were. And then 2020, 2018 and down, you're much more protected there. And then we look at your risk-adjusted 10-year return. So below is the 10-year returns by 10-year volatility. And you can see that you are doing great in there. The median was 0.66 on volatility. So you actually. And then we turn the page to page 17. You can see where everybody is funded. As of December 31st, the average adjusted funded ratio participating counties was 87.3, up from last year's of 81.4. Because of strong capital market returns. Remember, because they get the data, they get your market value, your actuary as of 9/30 this year. There. And then page 18, it's really nice where you want like to be. It's your adjusted funded ratio, we're right on top. So, and you can see you've got most counties are between 90 and 80, but you do have some counties that are below 60, 70, and there's one in there that didn't report yet, and they're close to 54. So, I mean, there are some, struggling there. And then if you look on page 21, you can see your investment consultant, banks that you're using, your actuarial firm, and where you are on that. And then if you look at page 22, you can look at your active participants, the number of counties have the percentage of active participants. Now you actually retired participants, you're a little bit lower, which is nice, and then terminated vested participants 6 to 8% there. So still actively employed, retired is no longer, and terminated vested, formerly worked for the county, eligible for benefits but not currently drawing them down.
I don't want to put my colleague, Mr. Prestipine, on the spot, but obviously my assumption is you pay the most attention to these things. Nothing in here is catching you off guard, is it?
No.
Okay. I think that gives me comfort knowing that. Thank you. Do any of the board members have questions for Sarah on this second document? Mr.
I
Rapone?
have it on the first.
Oh, on the first document?
Yeah.
Sure.
We're showing 105, 823, 290, as of September 30th. What is the most recent fund balance?
Well, as of the close of October, you were at 104. And that's not reconciled yet because it still uses the real estate. So if there was a huge jump going up and down because the market was like this, and now the market's up, that's why I didn't kind of go in and do that and look at that yet. So you're probably as of close of Friday, you're up over there.
Thank you.
Again.
David, we still, yes, coming off, so 101.3. 101.3.
Sarah, does that conclude your report on the two documents that you've
Yes,
given
it
us?
does.
I'll go around the table then, and I'll start with Commissioner Kennedy to see if he has any questions or concerns. Okay, thank you, sir. Mr. Prestipine?
Nope.
Mr. Rapone?
Yeah, thank you.
and Mr. Sanada. Thank you, gentlemen. Let me also, as a matter of housekeeping, note that the minutes have been provided to us of the August 13 retirement board meeting. Gentlemen, take a minute or two to look them over, and then whenever you would be ready, I could entertain a motion then for us to adopt the minutes.
I'll make a motion to adopt the minutes. I'll second.
It's been moved by Mr. Prestipine and seconded by Mr. Sanada that we adopt the minutes. If there are no questions or concerns, I'll ask Brian to call the roll, please.
Controller Prestipine,
Yes.
Treasurer O'Connor,
Yes.
Commissioner Sonato,
Yes.
Commissioner Kennedy,
Yes.
Commissioner Vogler,
Yes.
motion carries.
Thank you. The minutes are adopted. We move on to a couple of new business items. And first being a proposed resolution. Ryan, would you happen to know what number we would assign to this first resolution?
This is number 1.
Okay, proposed resolution 2024-1. You know what, I think mine are not in order. The first resolution is the one dealing with the Corn Ferry 3% fee increase, which would be found it's at the back of my packet. Is it at the back of your packet? So the last resolution that deals with the Corn Ferry fee increase, we'll assign that resolution number 1. Has everybody found that document?
Yes.
And again, Mr. Prestipine, I hate to put you on the spot, but I think we've all had the correspondence, but is there anything you wish to talk about regarding this?
No, they usually have an annual increase. This year it'll be 3%, which I believe, and the letter they gave us was about $72 a month or something like that, if the fees were to go up.
Okay. And I believe we were all in receipt of that. Again, I turn to you to make sure you don't have any significant concerns with that. Okay. Before I take a motion, does anyone else have conversation or discussion on this? Would one of you care to make a motion for proposed resolution 1, which let me enter into the record that this resolution states that the Lawrence County Retirement Board approves a 3% fee increase in their contract with Corn Ferry. That's the company that provides the actuarial services to the retirement board. Would someone wish to, and by the way, this would take effect on January 1 of 2025. Could I have a motion for proposed resolution 1?
I'll make the motion.
Thank you, Mr. Prestipine. Is there a second?
I'll make a second.
Thank you, Mr. Rapone. Discussion? Questions? Since I hear none, I'll ask for a roll call, please.
Controller Prestipine,
Yes.
Treasurer O'Connor,
Yes.
Commissioner Sonato,
Yes.
Commissioner Kennedy,
Yes.
Commissioner Vogler,
Yes.
motion carries.
Thank you. Next is a proposed resolution for discussion and possible approval for the rate of interest to be credited to member accounts for the fiscal year 2025 that would be set effective January 1. This would be the next to the last document in your packet, gentlemen. This would be proposed resolution 2. And it requires us, and I think we do this once a year, David. We have to come up with a percentage figure. And David, I assume you have the current figure,
Currently at 4.25.
4.25. Do you have a recommendation for us?
I would recommend to keep it the same.
Okay, thank you. Do members of the board wish to ask any questions about this proposal? The controller is recommending 4.25, that rate continue. Once again, before I take a motion, are there any questions or concerns about what you've just heard?
Is that what the rate's been in the past every year?
It's been that probably for the last few years at least. It was higher than that at one point and it got lowered to, I think, don't quote me on this, but I think at one point it got lowered to 4, then they raised it, then it was raised to 4.25, and it's been that ever since.
What is our range? I'm sorry, Rich. Oh, you're saying that?
The range, the lowest you can go is 4, the highest you can go is 5.5.
Rich, I didn't mean to jump ahead.
No, I think Dave, if you could just explain your justification for the 4.25 and not higher or lower.
Well, I mean, we just saw the Fed just lowered the rate. So, I mean, I think we're still, I think a little bit below that, but we're still in line with that because there may be another lowering next year, so you don't know that. But that's a possibility, so I think we're pretty safe in 4.25. I mean, we don't have to go by what they do, but I think we're pretty comparable to that. Raising it would cause us to just put more money into the fund. So, I mean, I think we're pretty comparable at 4.25. What's that?
Page 8. Salary increase assumptions on the rates. Can you look at that? If you have, let's see what else. Or wait.
Or never,
The highest one of anybody is 4.5.
yeah, real good compared to other funds. Okay, thank you for that, Sam.
You've heard the recommendation given to us by the controller that he's comfortable with maintaining the current rate of 4.25% with the understanding that we address this on an annual basis.
Yes.
Would one of you care to make a motion for proposed resolution 2, which would continue the rate at 4.25?
I'll make that motion.
Thank you, Mr. Sanada. Is there a second?
Also,
Thank you, Mr. Prestipine. Any further discussion? If not, we'll take a roll call, please.
Controller Prestipine,
yes.
Treasurer Racone,
Yes.
Commissioner Sonato,
Yes.
Commissioner Kennedy,
Yes.
Commissioner Vogler.
Yes,
Motion carries.
thank you, Ryan. And then the final resolution for us to consider today, I believe that the laws governing county retirement boards stipulate that every 3 years, we are obligated to review a potential cost of living increase for eligible retirees. It does not obligate us to necessarily take action, but we do have to discuss it every 3 years at a minimum. And if we were to take action today, there is a formula that we're required to adhere to. In other words, we don't have the ability as a board to say, yes, we'll approve an increase and we'll make that increase 2%. There's a formula that we have to adhere to, and the formula that has been given to us, if we were to take action, take effect in 2025, that would, the increase to the eligible retirees would be 3.4%. Mr. Prestipine was kind enough to look back to determine when the last increases were given, and I think there were 2 back-to-back increases, maybe about 7 or 8 years ago. 2017, 2018, and do you recall the percentages?
17 was 0.3%, 18 was 1.4%.
And again, those were the percentages that we had to adopt. And they, in large part, I'm assuming, correct me if I'm wrong, but in large part, those figures were arrived at by principally the rate of inflation at that time. I'm sure there may be some other factors, but I'm assuming one of the largest factors is.
It goes on the CPI.
There you are. And of course, that period, at the time we were able to grant those increases, the dollars to cover an increase have to come from the county's general fund. Am I correct? So it's somewhat ironic that you heard Mr. Prestipine say that right now, the fund is at least 101% funded. So we're actually above the 100% figure. It's unfortunate that we can't take that overage, if you would, and apply it to an increase, but I don't believe we're permitted to do that. So coming back full circle, the money that would be earmarked for an increase, which would have to be 3.4%, would have to come from the county's general fund. Now, is it my understanding, David, that this could be revisited next year? The law says we have to talk about it every 3 years, but there's nothing
You
saying
can't go more than 3 years without this.
without talking about it. But we could, if we so desired, talk about it again next year. That's an option we have.
You do every year.
Yes, we could. So in front of us, gentlemen, is a proposed resolution that if we voted on it today, could grant that cost of living increase at the required amount of 3.4%, which would take effect January 1, 2025. I can't recall, did you do a calculation as to what the impact would be, what the county would have to move forward to cover this increase?
Yes, it would be, from the letter the Corn Ferry gave us, it'd be around $1.4 million.
$1.4 million. And as I noted, sometime in
It's
20,
all recurring, that's just $1.4 million. We can either pay it upfront once, or you can finance it, which would end up being a little more,
right,
but that's not a recurring thing. Once it's paid, you're not paying any more for it.
understood. So there's nothing preventing us that, let's say, like 6 months, a year from now, we could talk about this again.
Correct.
Problem is, none of us have a crystal ball knowing what the rate of inflation might be 6 or 12 months from now.
It goes on the August CPI, we probably couldn't talk about it until after August.
I see.
We wouldn't know the number.
I got you. Okay. Well, I've talked enough. I'm going to start with Commissioner Sanada to see if he has questions or comments on this matter.
Just looking at the number, you're saying we cannot deal with this until next year, that'd be about a year from now. Would be the earliest, because we have to use the August figure. Correct. Because I'm looking at, trying to think of how the number would be, where we're at. I mean, if you look, it has been eight years. Just trying to get my bearings of how, this is our first year, my first year being here, to see how.
Yeah, because this one would take effect January 1st, 2025. If we did it next year, it would take effect August 26th, but we wouldn't know what that number is until later in the year.
Until later in the year. I think you answered my question.
And I should know before I didn't want to cut you off.
You didn't.
Okay. We're in a process right now of formulating next year's county operating budget, which we have to introduce in early December. So if the board took action today, then Mr. Vanasco upstairs would have to add to the budget an expenditure of an additional $1.4 million. Now, he would say to you that based on where we stand right now, that money would be available. Is that your understanding?
I have numbers here I can go over.
Please, if you wish.
What I went through here, which we currently, the financial statements are due in September. So just this past September, the 2023 financial statements were completed. And we finished with a fund balance in the general fund of $18.7 million. I went prior to COVID because the CARES Act money and the ARPA money are what's driving that number up. Those numbers are kind of skewed. So prior to 2020, the average fund balance for the prior 10 years that we carried on an annual basis was about $2.5 million. We currently have 18.7. So in my opinion, I believe we have the funding available to grant this increase and help these people out.
I appreciate in fact, I apologize. I probably should have asked you initially just to give us your entire
that's okay.
report.
That's okay.
So with that being said, do you have more to add?
No, other than, I mean, like I said, it's 18.7 now. I did look at where we're at the moment. It's on a cash basis now, so it's not exact. Through October, we have a surplus of revenues over expenditures of almost $400,000. That doesn't include tax revenue we're gonna get between now and then. It usually picks up in December, so then it may go up. Can't give exact number on that because it hasn't been converted to accrual basis yet, but if that continues, then $18.7 million will increase.
Did I hear you say that if everything holds true between now and the end of December for this year's budget, it looks like we'll end in the black?
Yes.
Okay. Do you have more to add?
No, I just, I mean, to get the room, the money in the budget would come out of that $18.7 million,
Yes, sir.
which I believe if you look at past years, there's plenty of room there to spend $1.4 million on this.
Thank you. Now, with all of everything that Mr. Prestipine has stated, again, I apologize to my board members. Should have had him present this all right at the beginning, so forgive me. Mr. Sanada, you've heard everything from David. Does that lead to any other questions on your part?
I'd like to deal with this, but I wish we could see the budget. Because we have not seen the budget for next year yet. I don't know about how much increases are there going to be. I know Mr. Vanasco has been working very hard, working with the different agencies and everything else within the county. And I know we have the expenses, but we have to do this today, correct?
I mean, unless we're gonna call another retirement board meeting between now and the end of the year, that they probably need time to get everything calculated, so I mean, we're kind of at the point where we have to get it done.
I ask because I'd like to see, I wish Joe had his budget now, we can actually see.
Because if we're doing it, we have to tell the actuary, they have to then calculate it in everybody's,
That's how
so that
that
we can,
process.
so that we can make the first payment in January, so we'll need time to do that. We don't have a lot of,
So there's not a lot of wiggle room where
Right.
we can deal with this, say in December, once the budget's introduced, but that would not give us the time.
probably, they probably cut it kind of close to December.
That was my question. Okay.
Anything else, Chris?
No.
Mr. Rapone?
Yes, thank you. I do want to say that for the past 17 years, I've sat on this retirement. And I get approached a lot by former retirees about our cost of living. And to me, they're always very worthy of it because of their service and their talent that they lent to the county all these years. And I've been very fortunate and blessed to work with many of those people over the past 17 years. But it comes down to the bottom dollar, can we afford it? Okay, and most of those times we could not afford it ordering the ones that we did and everything. Because to be able to afford it, it would have to be raising taxes and going to the taxpayers. And I never thought that was fair to put that burden on the taxpayers for this. Now, given this year in this situation, and in reviewing the county finances and seeing what David has said, I think now is an opportunity to be able to grant this to our retirees. We've all been affected by inflation in the economy. They too have been affected by the inflation in the economy. And most of us and our employees and our union members have received a decent cost of living allowance, okay? Our retirees have not. And knowing what I know and seeing the financial snapshot of the county, with our investments and with our balances and with what we have, I think now is an opportune time to grant this COLA to our retirees. And I just want to enter that into the equation.
Thank you.
You're welcome.
Any other questions on your part?
No, I don't have any.
Okay, thank you. Commissioner Kennedy?
I'm gonna tell you, I can't wrap my head around it. $1.4 million is a big number to me. And to give a 3.4 when we don't even know what we're giving our employees this year yet, a COLA. I realize they've gotten COLAs over the years since 2017 and 18. But 3.4 or 3.4% is a huge jump. I realize cost of living is been up, but what's gonna happen in the next 6 months? You know, is it gonna come back into where it really should be? Is the cost of stuff gonna come down? We can't predict that, but that 1.4 just keeps blowing me away. It's just a huge number that we're taking out of, and I get it, Dave, you know, you say we're sitting at 18 million right now. But I think we're sitting there because of some things we've done, and watched the money and didn't just go and blow it. We gotta continue that down the road. And to me, you know, if this was half the 1.4, I'd probably have no problem. But being at 1.4, I'm just an old country boy up in Wilmington Township, and it's a lot of money.
I do have a question.
Yes, sir.
And I know that we know what the union employees are given per contract, correct? And is it correct in saying that the at-will employees will normally get what they get, correct? Okay, so we kind of know what that is going into it. The only thing we don't know would be the elected officials, and that's also based on the CPI index of November through December, and that's a smaller group. Like I said, I have reviewed the county balances, the investments, and now is the time to do it.
you have other comments?
You guys have been there a lot longer than me. It's a lot of money.
And I'm not disputing that, $1.4 million is a lot of money, but I can't sit here and tell, when we have $18.7 million in a fund balance, we normally hold between 2 and 3.
Correct.
I can't tell retirees we don't have any money to give you a cost of living.
Rich, let me ask you this, because you know, if we had to take out a loan, and this year, coming year, 2025 with 18 million, we don't have to take out a loan. If we did, what would the interest cost us on that? What would interest would we be paying on?
You mean a tax anticipation note?
Yeah.
Oh, well, normally we've been very fortunate, even taking that out. I know for the past, would you say, Dave, 7 to 10 years, we've paid that off early and saved the county interest. We've had that paid off right after the discount period, because that's when the majority of our taxes are paid. And that's a history. We've never got, maybe at the very beginning we did go full term, but like rarely. We either paid it off after the discount, if not that, after the face, which is in early July. So we're not even taking out a strand this year. That's the good stage that we're in. We're gonna use part of what David has quoted, but then that money's gonna come back to us within 3 months. That's gonna be replaced. And I think when you compare, you said surplus of 18 as opposed to normally what has been there. It's 3.
On the prior 10 years before COVID, the average is about 2.
Yeah, I can't in clear conscience speak to our retirees and say we can't afford it. I mean, my goodness, that's an
We can't afford it,
insurmountable amount.
but 3 or 4 years down the road, we can't see that 18 could be back down to 2 million. And all of a sudden we're sitting there because we didn't watch our money. And this 1.4 just, and you guys have been here a lot longer than I have been. You understand a lot more than I do, but 1.4 is a big number.
Let me ask this question. When interest rates did their incline, if you will, when they started the upward trend of interest rates, and we very prudently decided that we would take these dollars, these surplus dollars, and invest them. Do you gentlemen have an estimate as to what we have pulled in from the interest while we've made these investments? A rough figure.
Sure, the $10 million one is the one that we just cashed out on, and we made probably about $575,000 on that investment. And there's a $5 million one that I believe we're not touching at this time, correct?
Yes.
Yes, so, yeah.
So are you anticipating Even though interest rates are starting to, a little bit of a decline, our projection is that as long as we're able to, we will continue to invest these surplus dollars, which should bring us additional revenue. Is that a safe assumption?
Well, that's something I would talk to David and the financial team, which is the three commissioners, as long as that interest rate outdid what the current general fund rate is. Why wouldn't we? And that's why we made that decision 2 years ago. We were getting 3% in our general fund, and then to take out a short-term CD, we were at 5%. And that's how we accrued the interest on it.
The other comment I'll make is that, and Dave touched on it, you know, there are a number of reasons we've realized this higher than average surplus. And in no particular order, you mentioned it, you know, we received CARES money in 2020, and then in 21 and 22, we received the American Rescue Plan dollars, as did every other county, as did every township, every borough, every city, every school district. That brought in revenue that hadn't been there before. Back in 2020, I was on a board of commissioners that voted for a tax increase. That was the last time we've had a real estate tax increase in Lawrence County. It's been 4 years now. But at the time, we found that we had to do that. I didn't take any pleasure in voting for it. I don't think my two colleagues at the time took much pleasure, but it had to be done. And again, fortunately, we've maintained a stable property tax rate in those 4 years. And then I guess finally, you know, we all go to the grocery store, we all put gas in our car, and we saw particularly, thank goodness it's starting to come down a little bit, but boy, there was that 2-year period when inflation was upwards of 9%, and our wallets took a beating. Well, so did the wallets of our retirees. So I'm factoring that all into this. Part of me would say, yeah, let's see if the inflation rate goes down and then in 2025 we can readdress it, and it might not be 1.4 million. Flip side is, because this is the part we don't know, it could jack back up and it might be more than 1.4 million. What we know right now is that figure. Yes, sir.
I do want to enter in as well. The controller stated that he did not factor the remainder of the 2024 tax collections into that, correct, David? Into that?
Correct.
Okay, so I can tell you, I can project another 1.2 million will be coming in revenue.
But we'll have expenses as well, though. Will those expenses,
Correct, that's why also expenses.
I assume they will not meet the 1.2 million? Or will they come, they may come close to it, but
Yeah, I mean, there'll be other revenues too, but we get taxed, but yeah, I mean, I can't tell you one way or the other, but I would probably think the revenues would be slightly above it, because this is the time of year where more taxes come in.
Right.
So I think they'd be slightly above the expenses.
And you're right, there was no crystal ball. Okay, there isn't. It could be worse off a year from now. I'm a firm believer, after reviewing everything, the burden that Ainsworth too in the bush, we have an opportunity right now. There still remains a surplus after that. Our retirees have been hit very, very hard. They've gotten nothing for many, many, many years. Like I said, I've been on the board 17 years and once.
Rich, if you look at it this way, let me just do some calculating. This hasn't been touched in 7 years. I don't know why. You guys chose not to do something. Or maybe
We've never had a surplus.
Well, that could be, but what it generates out of, if over 7 years we would have put $200,000 away, it covered us $1.4 million. But you didn't look at that. And you can't just put it, say, hey, we're gonna take $200,000 and throw it for the increase in retirement fund. If you reduce that down, now that I'm looking at it, even more, what's that equal out to 3.4 for 7 years? It's probably more realistic than I could get it in my brain a little bit more realistic than 3.4 or $1.4 million, because the employees here have had a constant increase over the last 7 years.
Again, in that 3.4, they're getting it in January, they'll get it going forward. $1.4 million, we're just paying one time to cover.
So this isn't a yearly thing, we get to match it, so.
No.
1.4
1.4 covers the 3.4% cost of living for the length of their pension.
So in 3 years or 5 years, we come back to this again and we look at it, hopefully the number's down and we're not having this constant. I get it, the cost of everything. You know, I was on the leaning the way of saying no way, but I started calculating a little bit better, figuring out over 7 years they've got nothing, and I think that was 7. Not probably all 7, but at least the last few years, tough years. I'm going this way a little bit, but I think that's where you guys are going. But, you know, if it was 2.5%, I'd probably say let's go for it.
That's the frustration, Dan, is that we're handcuffed.
Yeah.
But unfortunately, we get that number and that's it.
Yeah.
If we do it today, when's the next time we gotta look at it? Next year?
It would be in 2027.
So we'd have 3 years, so it actually takes it out longer than 7 years. You're at 10 years at that point. Okay, I'm good. I can see where we're at.
Thanks, Dan. Mr. Sanada?
I mean, I understand it's been 7 years, I think that's the main point. You know, costs have gone up. Trying to get my hand, I'm like Dan over there, because this is my first year doing this, okay? Trying to calculate, retirees are hurting, they need help, and you have the money. But I think the message we have to send, my philosophy is, you know, we have to be fiscally responsible, which we have been for the last 10 months, which we're planning on doing for the next, 36 months, Dan.
And hopefully beyond.
No, and what I'm saying is we're going to do that. And, you know, we try to be fair and try to be reasonable. Like you said, you make a point, it's been 7 years, bring it down. I mean, the way these things are handled at other levels is we actually make a number. We see what we can afford and we do it. It's just that the way they are doing this, is making it, it's either this number, take it or leave it. And I don't think that's fair to any board that has to make that decision, but that's what we're dealing with. And you know what? It's been 7 years. I think that's the key that weighs into the favor. We need to do something to help the retirees. Because they have hurt, especially the last 2 years. You know, I just wish that we had our budget, we know where we are, but then Mr. Vanasco does a great job, and I know he's been trying to be fiscally responsible to keep the costs down here. We're trying to do things to keep the costs down. You know, so I have to be reasonable on this. But I mean, our fiscal responsibility going forward, we're going to have to be very lean at this point, just because we don't know what's in the future. Okay, and you know, our goal is not to raise taxes, because you know, there's also those people that are working out there that have to pay their taxes every year. They've been hit up, you know, with the cost of living and other tax increases. So at this point, we don't have to do that. I don't want to do that. I don't want to do it going forward if at all possible. And our whole goal is to try to grow the economy. It's kind of the efforts that have been made this year, you know, through economic development to get more businesses, to get more houses built. We're just at the beginning of that, so that has to grow. But we don't know what the economy is going to bring, you know, nationally. We don't control that at the county level. And so this is not as cut and dry as it seems. I mean, you have to go between, you know, be fair to all. And, you know, at this point, you know, Dave, I respect your opinion a lot. You've been here a long time. You know the numbers. And that's what it comes down to. I like numbers to play with. I know Commissioner Kenny likes numbers. I think we all like numbers in a way, because I always calculate these things. And I'm more probably fiscally conservative when it comes to spending money on that spending money. And but if it's something that's going to be fair and reasonable and to help those that are in need, you have to do that.
Other discussion, gentlemen? I want to thank all of you for your approach to this. Obviously, it's been very businesslike, and I think we've touched on a lot of the factors that lead us to this point. I particularly want to thank both the controller and the treasurer for their research and their input on this. We have in front of us proposed resolution 3. And if we were to approve it, based upon the legal requirement that every 3 years we have to consider it, and based upon the legal requirement that if we approve this, the rate of the increase would be 3.4% in 2025. Again, we're bound by that. We don't have the flexibility that we might like to have in terms of establishing perhaps a different rate. This is what we have to accept. So I'll ask at this time if a member of the board would care to make a motion on proposed resolution 3.
I'll make a motion on proposed resolution 3.
And that motion is to approve it, Mr.
To
Raton?
approve the 3.4% COLA for all retirees.
Okay, thank you, sir.
I'll second.
Thank you, Mr. Prestipine. Other comments, questions, or discussion, gentlemen? Sarah, I feel bad we're holding, in fact, you don't need to leave, do you? We're almost done anyway, but I appreciate your sticking around.
It's interesting to listen to.
Okay. Well, and you know, I know you deal with a lot, excuse my digression here. I know you deal with a lot of different counties, a lot of different personalities, but I think you'll notice the integrity of these gentlemen and again, how they all conduct themselves in a very businesslike manner. That doesn't happen in every county, does it?
No, I've been to a few sometimes over the years, nothing very nice.
Well,
So,
I'm proud to work with all 4 of these gentlemen. Today proves why. Anyway, I digressed. I'm sorry. We have a motion on the floor. It's been seconded. Final comments or questions? Okay, hearing none, we'll take a roll call, please.
Controller Prestipine,
Yes.
Treasurer Raton,
Yes.
Commissioner Sonato,
Yes.
Commissioner Kennedy,
Yes, I got it.
Commissioner Vogler.
Yes?
Motion carries.
Thank you, Ryan. Again, thanks to all of you gentlemen for the thoroughness. We didn't take this lightly. Public comments, we have no members of the public in the room. Sarah, do you have any final words of wisdom for us?
No, none. Just everybody have a wonderful holiday and I was like, only one, and it's great having to work with. I look forward to seeing some of you at the conference in the next week.
We appreciate all the hard work you and your staff do for us and your professionalism. Closing comments from my fellow board members. Hearing none, this would take us then to adjourning. May I have a motion to adjourn this meeting?
Motion to adjourn.
Second.
All those in favor, please say aye. Aye, opposed, the same sign. Motion carried. This meeting is adjourned. Thank you, everybody. Do you want these back?
No,
They're for us to keep.
They're
Okay.
absolutely, I just think sometimes sharing it with us. And we
Understood.
went through it.
Hey, Sarah.
Understood.
I don't think I-
We got a
I
long
just
third.
sent it to you.
Thanks, David.
You're welcome.
I was asking.
Oh, yeah, I know, there's a button we have to push on that.
Yeah.
Usually
Oh,
We'll figure it out. It looks nice.
Bill runs in, David, I'm tied up. Well, we got an hour, gentlemen.
So-
We'll run out and get a seat.